Bitcoin breaks 100K, but it doesn't last for long. On-chain data shows long-term holders selling out, and call options are also getting closed in December and Jan expiries. And Ethereum has some wild swings, and the implied vols suggests more to come. All this and more in this week's Crypto Options Unplugged. Welcome back to Crypto Options Unplugged, everyone. I'm Imran from Options Insight. I've got this hoodie on finally for a change. I've got my man Dave from FRNT. And today's special guest is Christian Gressel, Head of Business and Development at Abex. How you doing, man? You all right?
I'm well, thank you. How are you?
Good to have you on the show.
Thank you very much.
Yeah, welcome. Yeah, really good to have you on.
Hopefully.
So you two know each other already, don't you?
Yeah.
You know everyone
knows Christian.
Yeah, everyone. Yeah, I don't know anyone in crypto like you.
No, but yeah, I've known Christian for a while and through the crypto network and like what they're doing at Abex and building at Abex, which we can get into, which is really interesting.
Right, before we get into that, 100K couldn't hold, man. You were a week late, first of all, and now it can't hold. What's going on?
I know, like, it wasn't even a week late, a few days.
Yeah, a few days late.
Like, a few days late on our bet. We had this bet on that,
Okay.
like, we'd hit 100K by the end of November. So I was a few days out on that. But yeah, like, I mean, like when it first went through, it looked like it was going to sort of sustain
It went
itself.
straight to, like, 104.
Yeah.
There was liquidations, wasn't there, on the way up there?
Yeah. But like, I feel pretty good about it all. It's funny because it feels, I mean, God, if you look on Twitter and stuff at the moment, you think we're back down at 70K. It's like, oh, this is it, the bull market's over. But it looks to me like, obviously, we finally took out like 100K, and there's probably some shorts around there that's been sort of taken out. And now we've consolidated back lower. There's a bit of supply coming in, clearly long-term holders selling.
Yeah, that's what the on-chain was showing, right?
Yeah.
But MicroStrategy kindly taking it off their hands.
Yeah, that guy.
I mean, he's bought like, what, 16 billion recently since the election?
What's he say? He's going to be buying the highs forever, right? So he's happily taken that. There was some like MT Gox stuff and some of the US government FUD like that the Silk Road coins moving wallets again.
Right.
So maybe there's a little bit of supply as well, just coming in here from that and offsetting a little bit of that demand supply dynamic. But like inflows into crypto and last week were huge again, like huge. So I think that.
What was the numbers? You remember?
I forget what the numbers were. CoinShares put out like their piece, and it like again record kind of inflows into Bitcoin products, not just the ETFs, but
I suppose the thing that concerns me though is if a lot of the coins are moving from long-term holders who've held it for like 4 or 5 years into short-term holders' hands, are they going to have the kind of, staying power, or do they need to be shaken out, right? That's often, if you look back at past cycles, that's what happens, right? The long-term holders give it to the short-term holders, and then these are the weaker hands, and you need a bit of a shakeout, right? And I wonder whether that shakeout is upon us.
Yeah.
Right?
Yeah, I mean, it's always the fear. I still feel there's like real demand, like coming into this market, as we've spoken about, sort of post-Trump. I just see where we're at as just a pure, very. I mean, it doesn't even really feel like much of a correction. It just feels like we're taking a breather.
Yeah, so far.
Yeah.
Although we had that flash crash down to like 88.
Yeah, true. Yeah. So you kind of think a lot of people washed out through that. So let's see how we go here. Obviously, my thing is to always just look at the fundamental story and the fundamental macro. That's actually got more supportive over the last sort of couple of weeks, few weeks. We started to see US rates come lower, US yields come lower. We started to see the dollar come a bit lower. So that side of things looks good. Last week we had non-farm payrolls, which was obviously bounced from the week one that was before, but it wasn't strong enough to dissuade the Fed from cutting rates next week, which they look like they're going to do. We also had, which I thought was not many people were speaking about, but we had a very sort of weak services ISM. So I've kind of spoken about the sugar high of the economy that we had into the election, as they obviously spend money into the election, which I think will kind of come off of now. So that kind of lent into that story a little bit. So I still think we're on for the US economy in this softening, not collapsing US economy that allows the Fed to keep cutting rates. So obviously they're talking about being a little bit more cautious with the rate cuts and all that stuff. But we're still going into this easier rate environment. China data just on Monday was very weak. They're in deflation territory. I still think that they'll emit that deflationary pulse across the world, so that'll keep global rates coming lower. And now you've got China, sort of quite big news yesterday from the government there, saying that they're going to move to a moderately loose monetary policy.
And a proactive fiscal.
Yeah. So
it's words though, right?
Yeah, and but up to now it's all been words, right? And they have done stuff, but obviously there's been, is it just swapping one debt for the other and all that? But
the market believed them though yesterday.
Yeah, but I feel like last time they did this was like 2010, when they moved from a prudent to a moderately loose policy. And then the fiscal came quite shortly after. So that they obviously know that they really need to step the game up. So I think there's a lot of liquidity and support coming to the markets from China. I think everything looks good. So fundamentally, like there's nothing for me to, other than crypto being crypto and just some leverage getting washed out. But you're seeing now some like negative funding rates already appear. So a lot of leverage is being wiped out already. So I kind of feel that we stabilize around here. CPI tomorrow, which is going to be kind of a big data point, and obviously Fed next week. I think market might chop a little bit into that. Fed cuts rates, and then we'll have one last little rally into Christmas, and we'll go home happy.
Nice. All right, Christian. So tell us a bit about what you're doing then. Well, before you tell us, give us how'd you get into crypto and how long you've been in crypto markets?
Yeah, brilliant. Very happy to. I sat on a macro trading desk at UBS, where we were mainly executing clients' orders in options and futures, predominantly on short-term interest rates and fixed income products. But we came across Bitcoin at the time, and I think it was probably 2013. Bitcoin trading around about single-digit dollar value, and we started looking at it and discussing it on the desk. And some of us were super bullish, and the other ones kind of thought it was a complete fad and nonsense. But that's really when I started looking at it, and I remember some of the options market makers that we spoke with on a daily basis that were mining it from their bedrooms, and again, we thought like, oh my god, what the hell are they doing? I'm pretty sure they're quite happy with what they were doing.
They're laughing all the way to the bank now.
And I never did anything with it, but I kept in contact with the concept and continued looking at it. Followed the whole Mt. Gox episode. Followed the Ethereum birth and how that all of a sudden exploded, followed EOS and, that whole story and kind of how it faded away again. Sort of at the same time, within banking, continued my career and sort of probably passed into a slightly different topic, which is electronic trading and algorithmic trading, and concentrated on that. And eventually, when I left traditional finance, I was looking at it and thinking, okay, what do I do with 2 decades of experience in markets, not wanting to do the same job at a different house, and really thought like, okay, this is my opportunity to do something in crypto and sort of try and use the skills that I have and find a company within crypto that might need them, and found Abex, which were looking for somebody on the sales and business development side at the time, and immediately hit it off with the CEO. He's from Tradfi as well, and we spoke about the things that they want to achieve within Abex and what I could bring to the table, and that's when I joined them.
Nice. And so what is it that Abex offer clients?
Yeah, so Abex, the whole idea behind Abex is really to provide electronic and algorithmic trading infrastructure in the way that we're used to from an institutional grade. So really the fundamentals of trading, good algorithms, super low latency, high frequency, and enable clients that don't want to build that infrastructure themselves to actually use it in a typical brokerage setup where they end up paying a fee for the volumes that they execute, but doing it the right way. So looking into not necessarily how can we get away with the least amount of regulation, but looking at it, how is the space going to look in 5 years, in 10 years? What are the regulators going to require of us? So, I mean, we immediately, or from day one, we thought to get an FCA registration, which we got a couple of months ago. And building everything correctly with transaction cost analysis, with transparency, with good algos. And that's that's going to build the foundation of what we're doing. That's going to enable us to know where the market is, to understand where the market is, to understand how to trade the spot part of it. And then longer term, which is like really, really interesting, is we're going to use all of that information and all of that capability to go into the derivative side and the option side and be able to price that correctly.
Nice. So give us an example, I guess, of like some of the algos that you guys might create that kind of make life easier for traders at an institution, right? Like, what are the sort of things people are looking for in terms of solutions?
Yeah, I mean, and again, it's sort of a multi-phased approach. And stage one really here is provide the right tools for the clients to execute spot. That's stage one.
And that's across like multiple exchanges?
That's across multiple exchanges, multiple products, doing it in the right way. But what does that really mean, right? So if you look at, especially 2 years ago when I joined, if you look at the tools available, there were some algorithm providers that were out there already that offered clients these type of strategies, but they were quite basic. The latency wasn't at the forefront. There still needed to be a lot done. The intelligence of the algos wasn't very good. If you look at Abex, for example, we're a relatively small team, but at least half of our team are actually on the quant research side. So they're PhD people that look at things like order book imbalances, momentum, signal research. So things where we can then use those to determine where's the next tick in your underlying going to be. And what that helps you with is clients that want to execute, they don't end up being pure price takers. They actually start being price makers, or at least not being completely overrun. So if you today, for example, want to trade a bigger or any kind of trade in crypto, and you wanted to use an algorithm, if you use one from Abex, what happens underneath is you choose your, do I want to trade a TBAP? Do I want to trade a VWAP? Do I want to trade a volume in line or a spread trade? It doesn't really matter. But you give us that instruction, and then underneath that we have the what I would call the micro strategies that mimic what a trader does. So they go like, right, what's the market doing? Where's the bid? Where's the offer?
And does that reduce your fees as well if you go from being a maker, from a taker to a maker? I guess that's a big saving, right?
Absolutely, right. Yeah. So if you look at sometimes, especially in the more liquid markets, the difference between bid and offer, the difference between passive side and aggressive side is actually much, much smaller than the basis point fee difference between being a taker and a maker.
Oh, interesting.
Now, you can take advantage of that, and you can try and be the best maker or just, somewhere in the middle or something in order to get the maker fees instead of paying the taker fees.
And is some of the logic in your algos kind of looking at the funding rates and kind of trying to kind of identify where the cheaper funding rates are if people are buyers, and if they're sellers, where the higher funding rates are and stuff like that, and do that automatically for people?
Yeah. So, I mean, you mentioned a very good point. So in our development, the derivatives is the next phase. So at the moment, we're ready for spot, and that is all built out. Right. Derivatives is the next phase. Options is the last phase. But in the Delta One derivatives, as you say correctly, funding rates are super, super important.
They're moving all the time, aren't they?
Exactly, and they're different on different exchanges. So it's not only you then come into a space where you not just only have to understand the price, you actually have to understand the mechanics of the price, and whether maybe an absolute number on this perp is different than an absolute number of this perp, because you need to understand what the funding rates are underneath it. And we'll be able to do that, right? The beauty of the algorithms really is that the processing power of computers allows you to take all that input into consideration at a very, very quick and fast pace that maybe as a normal trader, as a person, you're actually not able to do because it's too much information.
So Dave, I'll ask you something actually. Like these funding rates, right? They're like 15%-ish now or something like that. If you go out to next year, like all the instos that are coming in the space, all the liquidity that's in the space now, why are these things not getting arbed out faster? Why do you think they're so persistent that these funding rates can be in the 15% range?
Yeah, it's fun. I was having this conversation with someone earlier. Yeah. I think I'd be interested to get your view on it, but I think a lot of it's still the fragmentation in markets. I mean, like you can sometimes see an arb, right? You can see it, right? And certainly sometimes in like the options sort of world, like you can see these arbs. But I think like because of the fragmentation, like so if people aren't onboarded to a certain exchange, you can't necessarily change trade across all exchanges to close out the arb. And we've not got robust prime broker solutions to allow you to easily move your collateral around to close out those arbs. So I think there's problems like that just make the whole process of arbitrage a lot slower.
Okay.
So sometimes I think you probably see an arb and you go, but I'm not onboarded on that exchange. Or if
surely someone, like there's some funds out there, like it's their job to do that.
Yeah, of course, and they do. But and then you've got the whole how am I moving my collateral from that exchange to that exchange, and then the one that's in the money, I need to get that collateral over to there.
Because me and Christian were talking about this earlier, and the reason why maybe not everyone can buy spot Bitcoin, right? They may not be willing to like have the blockchain risk, right? So they'll be willing to like buy CME futures, for example, because they trust the CME, they trust the clearinghouse as a counterparty risk being taken away. But because they're not willing to run other people's money and put it on the blockchain, right? And take their risk that the blockchain gets hacked. Not that Bitcoin has ever been hacked before, right? But like, that makes sense. But then once you introduce IBIT and ETFs on spot, then that makes it a lot easier, right? People can just buy a spot ETF and then sell the expensive futures against it and arb it that way. So I still don't really understand why, once the ETFs came along, that should have closed out a lot of these arbs, right?
Yeah, but again, it depends what platforms and exchanges the arbs exist on. And then I think the other thing you make quite an important point. Like in crypto, particularly when you start looking at perpetuals and stuff, not all prices are equal because of things like funding rates and stuff like that. So again,
does that mean CME? Like, do CME futures generally trade with much lower funding rates than other exchanges? Because like all the instos can trade on CME, right?
Yeah, well, it's a bit like you've got like on like the CME, like it makes a difference. Say if you're like coin margined, say like on Deribit versus being sort of dollar margined, because then the risk profiles are different, right? So things will trade at a premium because of that, but that it doesn't necessarily make it particularly easy to arb because it exists there for a reason. But yeah, I think it's like the fragmentation still across the market, right? That it makes it more difficult to quickly close out these arbs. I don't know if you have like another view on it. And
I mean, I think you're totally right. I think it's the fragmentation that drives a lot. I also suspect, and this is now pure speculation, but it's that the short-term interest is very much driven by the derivatives push, right? So if you think that Bitcoin is going to go up over the next couple of months or couple of weeks, you're going to put on a perp or a future, and you're not necessarily going to try and get all your cash out and do that via the underlying. So I think it's also the directionality of those funding rates is probably quite supported by general bull markets as opposed to in the bear markets where it comes down, right?
Yeah, I mean, I can understand an argument that in a bull market, in a bull trend, because the speculative money is chasing Bitcoin and wants the beta to crypto, they are pumping those futures to quite high levels, right? And the people who are willing to forego the crypto beta and say, I'll just take the risk-free 15%, thank you very much. I'm not after the doubling my money in 3 months type move. So that edge is there for those people who are willing to forego the potential upside in crypto, basically in a bull cycle, right?
Yeah.
So that kind of makes sense to me, but like that bull cycle is not necessarily going to last forever. So then I suppose that when we get out of the bull cycle, we don't tend to see it as high funding rates theory, right? But we still do see positive funding. That's the persistence of the positive funding.
Yeah.
Going longer out does surprise me. To be honest. Yeah.
But I mean, it's funny because, you know, FRNT, we've got sister hedge fund Paradox, and market neutral hedge funds, and that's just like, you know, what they're doing. They're trying to arb out some of these, differences. But it's funny now, like in a bull market, and like the fund returns on average, 30% a year. And people, it doesn't seem great. Everyone wants a direction.
That's the thing, because your benchmark, exactly. If your benchmark is the average crypto asset, and you're sitting there capturing 15-20%, you're going to look silly.
But which it shouldn't be, right? We're a market neutral fund.
So your benchmark shouldn't be that.
It shouldn't be crypto performance.
No, that's right.
It should be some other market neutral fund or
right.
But so it's interesting. But again, it just speaks to, like, there's the fragmentation, like in these markets that we've come a long way to addressing, but still not there. I guess that's why someone like Abex in what they're doing, like from an execution point of view, again, it's because it's difficult. It's difficult to execute like flow across lots of different platforms and do it efficiently. So I think it's interesting that you guys have got TCA, transaction cost analysis.
Right.
This was when I was in FX. Became a big deal amongst the institutions. So the sort of days of just sort of free for all in FX and just we'll execute at best, I'll tell you where you feel type thing. It became, from a regulatory point of view, they had to have this TCA in place so that that they could show that they're like best execution and all that. And again, it just speaks to how quickly this market's evolving. That institutions coming in go, well, look, here's a company giving you TCA on your execution.
Something else that I think is interesting about people like Abex coming in, right? I was asking Christian, like, do you have algos that allow liquidity providers who, let's say, they take on a block of risk on an altcoin, like a random one, right? Do you have algos that then help you identify like what basket of alts to use as a hedge to that if you can't get that altcoin back, basically, right? Kind of manage it, because that's very much a kind of electronic program trading type exercise within banks, right?
Yeah, absolutely. And I mean, I think the key word here is correlations. And that's certainly something we've started doing, is measuring correlations between different asset classes. And that goes beyond just looking at, let's say, altcoins or Bitcoin or any of the crypto. You can also look at things like, for example, the NASDAQ, and from there identify where your next tick in Ethereum is going to be, because there's, the correlations within financial markets are there.
Are they quite stable, do you think, those correlations?
In general, they are.
I feel like it moves around a lot.
So, no, of course they move around, but in general, and I guess you can put things into individual baskets, right? Now, the correlation between some obscure meme coin and Bitcoin is probably not going to be very high, right? But if you look at things like your top cryptos or Bitcoin, Ethereum, and the NASDAQ, or they'll be much more stable. And there'll be phases when that correlation breaks, and you need to figure out what to do at that point. And then there's phases where they're absolutely stable and it's mean reverting, and you can take advantage of that. I guess with algos, it's always very, very important that you have a model as underlying it, and that model drives the decision of the next tick, and that's what we're trying to do.
And you obviously, you're a seasoned trader in the Tradfi space, so you look at options markets as well. Have you got any big picture views around volatility in the crypto space and like the implications of what we've seen in the last few months and all the new institutional flow that's going to come into the space? Any thoughts around that?
Well, it's an interesting one. So, I mean, you would expect, like, if you take a super long-term view, you would expect volatilities to come down, right? I mean, ultimately, we are although we've come a long, long way, and the years have aged us quite a bit. It's still it's still a nascent asset class, right? And it's an asset class where I mean, if you listen to some of the predictions out there, that's still gonna 10x, 20x, 30x, whatever, right? Like grow, right? Grow tremendously, and that growth comes with volatility. It can only come through volatility. But the asset, the industry is going to mature, and our valuations are gonna get higher, and as the valuations gonna get higher, overall volatility has to come down. Now that doesn't mean that there aren't phases in between where either all hell breaks loose, or we're in a rampant bull market where volatility spike. Of course, that's going to happen, but overall, I think volatilities are going to come down.
Yeah, I mean, speaking on volatility, I mean, the move that we've had from say 65k to 100k, I would have expected like vol to shift quite a bit higher on that move, and the vol spikes have been very short lived, right? They literally get sold immediately because people who have then bought calls in for that move are ready to sell them back out again, right, and take profit. So like we saw that recently when we popped above 100k, there was a little influx of very short-dated calls who were trying to play the break. But the minute the break didn't really continue, we saw people offloading December, January upside, and that's what really kept a lid on the vol on Bitcoin. Whereas Ethereum's the one that's caught the vol bid actually since the election, because people are now saying, okay, well, the Bitcoin move to 100k is what we were anticipating. It's done. How much more can Ethereum go? It's miles off its all-time highs still. And if it wants to go and it suddenly steals the narrative, there could be like a quick 20, 30%, right? And you don't want to get caught short vol on that, basically. So ETH vols, even though realized vol this week has converged somewhat between Bitcoin and Ethereum, they're both in like the 60s. Ethereum's still holding nearly a 20 vol point premium to Bitcoin.
And what does that normally hold? Like,
so I mean, it goes through phases, right? I mean, back in the day, I'd say 10's about the average, right? Yeah. But we had a period where ETH, because there was loads of call overwriting on ETH even went under Bitcoin vol, right, for quite a long period of time. But all that overwriting seems to have gone away. It's certainly not impactful anymore, right? So I think anywhere between 5 and 10 is where it normally lives. If it's sub 5, it's probably quite cheap for Ethereum. And if it's kind of above 15, it's kind of starting to look quite expensive, I'd say.
Yeah. So what do you think the options market's telling us right now about where we head from here?
Well, we saw a bit of a collapse in call skew again in the front end, but the back end call skew still persists. So it's like, again, it's very much any weakness we're seeing is short term. Maybe we're a bit capped between now and year end, and then it's game on again for next year. So, do you buy? I probably don't buy Jan upside. I probably buy March or longer to be more safe that you get the next leg up by then, right? The trade that I did before the election, the calendar trade.
Yeah, short.
Yeah, the short like the 8th of November, long the end of November, right? Yeah. I think that setup's there again to sell December calls and buy January or February calls, basically, right? So I think I think it's going to be quite hard for us to materially break 100k by year end. But I think once that's done and all the noise around the inauguration and all whatever they're going to do next year, that's going to probably bring some optimism back, and then you'll start the year on a strong foot. And so I think that calendar might perform quite well again.
Yeah, interesting. Yeah.
Interesting. So you're not you don't see the year-end rally coming in.
I'm not feeling it. I'm not feeling a big break of 100k, but I don't think we see 120k by year end, like some people think. Yeah. So I'd sell that scenario.
I think we see 110. I think we see 110.
See 110.
Yeah, I do think like I think the macro again. Now we've had the initial post-Trump kind of this massive demand surge sort of come through, this catch-up trade. I do think the macro now starts to become a little bit more important. I do think the Fed next week is obviously important. Given the move we've had, it makes sense to kind of step back a little bit and just see what they do. And there is uncertainty around the Fed, and it looks like they're going to cut, but will it be a hawkish cut? And all these things. They seem a little bit sort of spooked by some of the recent stronger data.
Yeah.
But I think the fact remains they're going to cut, and then I think everyone go, okay, like coast is clear. We can kind of get long on this into year end.
I feel like there's another bet in the
110k.
110.
Right? Yeah. Well, like
110 by year end.
I still just feel like there's this real demand coming into the market, and so we have this real demand come in, and then obviously everyone piles in with leverage and all that, and then we break 100, and then then some sellers come in, some long-term sellers, and whether there is some Mt. Gox stuff and distribution, some of that supply, and then all the leverage gets like washed out, and we're seeing a big washout. But I think the real demand will just keep us kind of just grinding.
Yeah, I guess my counter to that would be, say I'm an insto who wants to allocate, right? Am I going to do that in that illiquid period between middle of December and end of December?
Yeah.
Like, I'll probably want to not have too much price impact, right?
Yeah.
So would I not be better off waiting until Jan to start doing that?
Yeah, and it's always a question, right?
Yeah.
Because on the one hand, you go, well, everyone kind of squares.
Everyone's going to do it.
Everyone kind of pares down risk into year end. But then, you know, you also see those that want to pre-position because no one wants to come in 1st of Jan and go, right, I've now got to try and get into this, and it starts to rip.
But haven't those guys already pre-positioned, which is what got us up here in the first place? That's the question, right?
Yeah.
That's the thing we won't know the answer to.
Yeah, and we'll sort of find out.
Yeah,
I just feel that as a market, we're still underpositioned. Like, I mean, generally Bitcoin's been very underpositioned and people are sort of coming in. So I still think that there's going to be this powerful demand.
There was an interesting metric that I saw, like Korean retail trading flows dropped dramatically from like 25 billion to like 5 billion, right? You also had Binance flows that were in like the 50 billion plus. They've dropped quite a bit as well. So we've seen quite a lot of froth, quite a lot of speculative retail volume that's helped us get up to 100K. And that's kind of fallen off a cliff in the last week, right?
Yeah.
So I wonder, you know, is that suddenly going to come back between now and year end? I doubt it, right? And if that doesn't come back, I wonder, you know, I don't know. I just think there's a lot of things that will maybe make people think, okay, we've had our move, we've had our year end rally already up to 100K. What's the value in me chasing it here in December, right? I might as well wait, because if we're in a consolidation phase, let that play out and then pile in. So I kind of feel like if we can consolidate, you're going to get a stronger rally in January, right? If we can kind of consolidate between sort of here and 85K or whatever, then the move you get early next year will be special, because everyone will feel like we've had the pullback. Now I want to take the chance to buy it, basically, you know?
And by the way, I think this consolidation again is healthy.
Very,
right? You know,
very healthy.
Like, but that's what I like. I love the price action right now, because like throughout the whole thing, we've had these like big moves and then consolidation for a bit, big moves. Like if to be honest, if we'd blown through 100K and if we were sat now going, we're now 130K or something,
that would be scary as hell.
You'd be scary, yeah. Like God.
I'd be out of everything up there.
But it's kind of again, it just looks really healthy. A little washout and leverage. Now we're back around that 97K. I do think like it looks bid to me. Like
there's good support underneath.
It looks bid, and like I mean that I was busy partying in Toronto when we had the sort of washout. And below sort of 90K, like past sort of markets, that becomes a real fucking mess, right? But actually, we bounced back and then ground back to 100K very, very quickly. So I think that shows you the strength.
It does show a lot of strength, yeah. It does.
I mean, other things that I would worry about into year end, like liquidity dries up.
Exactly, that's right. You always get the window dressing.
Yeah, the window dressing. Yeah. So sort of banks aren't extending balance sheet anymore. So generally liquidity dries up, dollar goes a bit bid. Yeah. So we've kind of got all that.
That plays into my calendar idea.
Yeah. So I kind of I always feel
I'm so going to get you into one of these calendars.
But I talk about like the Santa rally, and I kind of feel like people want one last hurrah into.
No, you want one last.
I want one last.
I don't know if people do, but you do.
But I still think as well, people are chasing performance a little bit, so might want to try and we've got a couple more weeks to kind of make that.
Yeah, it's going to be interesting the next couple of weeks, definitely.
Yeah,
I mean the S&P is kind of still pretty near its highs, right? Equity sentiment is very bulled up.
Yeah,
everyone's bullish for next year. We're at all-time highs. There's a little bit of action under the hood in equities, actually, right? I don't know if you saw there was a big momentum unwind yesterday.
Yeah.
Like it was like the biggest sort of Sigma move since like 2022.
But by the way, I tweeted about that earlier as well. That momentum unwind, kind of that's what makes Bitcoin and everything look fine to me. I'm like, we unwind of momentum trades across the board.
You did, yeah.
And
crypto's
Bitcoin,
in that.
And crypto's
club.
in that club, yeah.
Yeah, that's right.
So it just feels fine. Like nothing feels, out of the ordinary that would alert me to, oh shit, we're going to have a bigger correction here. I'm like, momentum just faded a bit after we move. Got big data tomorrow in CPI, Fed next week. Kind of makes sense that we'd take a little bit out of this.
Yeah, before we wrap up, do you see CPI as much of an event tomorrow? Because we're already at 85% probability of a cut, right? Is that
yeah, I don't think it's going to impact what the Fed do next week. I also think the Fed's focus right now, and unless that accelerates, like at some point, the Fed's focus now is on the labour market. So I think the market's beta, if you like, to CPI is a lot lower than it was.
Yeah,
now you want to look more at the labour market data. But still, it's still a risk event that you have to navigate in case there's a surprise.
But again, you got to think the asymmetric move, if there is one, has to be if it's higher inflation, because lower inflation is just going to cement the rate cut, right?
I disagree in the sense of, number one, it's not going to impact next week. I don't believe.
Okay, so
right? So that's unless it was some blowout number, Number two, I think the market's gone too far in pricing out this US reflation trade and pricing out the Fed. We kind of, it reminds me of earlier in the year when we had, I guess like second quarter of last year. So we came into the year, data was weak, Fed are going to cut X amount of times, and last December, dovish, Powell was super dovish, and then the market overpriced cuts for the year, and then we had this like run of pretty decent data. I guess sort of in the end of Q1 into Q2, and it's like, and then there's people talking about they might even need to hike, and I'm like, that's ridiculous, it's not going to hike.
No, that's not.
And then we faded again, right? And then we got this weak data into when did they go 50? Was that September, October? And they,
because it missed the September one.
Yeah, and the data kind of started to fall away, and now the data's picked up again, and everyone's gone, oh, like we got this, like data's coming in really hot. They shouldn't have cut 50. They made a mistake. Stepping back, that's why I'm still in this thing. We've still got a slowing US economy that's disinflationary. We've got a slowing global economy. Rates are coming lower. Real rates are too high. I think the Fed want to get back to like 3.5%. Now, how quickly they do that, again, they'll be a little bit nervous if data comes in strong, but they're still going in that direction.
Yeah.
So we've still got rate cuts ahead. We've got an easier rate environment, easier liquidity environment. So I still think everything looks good, and the rest of it is all noise.
All right, let's wrap it up there. Christian, it's been great having you on the show, mate. Thanks for coming.
Thank you very much for having me.
And remember, guys, like and subscribe so we can continue to bring you great guests like this.
And Christmas special next week.
Yeah, we're going to have our Christmas jumpers on next week, so look out for that. No more hoodies.
Hoodies as well.
No more hoodies. I'll catch you all next week. Cheers for watching.